A lot of people hear FHA loans and think two things: first-time home buyer, bad credit. And while FHA loans are popular with first-time home buyers, and they can be more flexible when it comes to credit, it's not the full story. An FHA loan can be a really good tool if you understand how it works, but it can also cost you money, limit your options, or create issues during the transaction if you don't know the rules before you get started. So in this video, I'm breaking down everything you need to know about FHA loans in 2026. We're going to talk about credit scores, down payment, mortgage insurance, student loans, condos, FHA appraisals, renovation loans, seller help, flips, and some mistakes that I see buyers make when they assume that FHA loan is their best and only option. If you're new here, welcome. If not, welcome back. My name is Daniel Walcott. I'm a realtor in the Washington, D.C. metro area. And on this channel, I help buyers, sellers, and real estate investors make smarter real estate decisions. First, what is an FHA loan? An FHA loan is a government-backed loan that is insured by the Federal Housing Administration. But you don't actually get the loan from the FHA, you still go through a mortgage lender. And that lender has to follow FHA guidelines. And a lot of times they're gonna have their own internal rules on top of that. That's important because sometimes a buyer is gonna say, well, FHA says I only need this credit score to qualify. But the lender says, well, for our company, we require something higher. That's called a lender overlay. You're gonna see that a lot. So FHA may allow something, but it doesn't mean every lender is gonna approve it. One of the biggest reasons that FHA is so popular is because of the lower down payment, 3.5%, and the more flexible credit guidelines. Under FHA guidelines, if your credit score is 580 or higher, you can qualify for 3.5% down. If it's lower than 580, you'd have to put 10% down. And let me just say, if your credit score is lower than 580, you probably shouldn't be buying a house. I would rather see you pause, work on your credit, and try to get in a stronger position instead of putting 10% down on the FHA loan. Because at this point, you're tying up a lot of cash and still using a loan product that comes with mortgage insurance. For some buyers, that's going to be the only path forward. But for a lot of people, it may make more sense to clean up the credit first, get the score up, and then revisit your options. Also, if one lender says no, that doesn't always mean you can't use FHA. It may mean you just need to talk to another lender. Because again, every lender has different overlays. Every bank and organization are going to have their own different separate rules. So you can go to 3 different lenders and maybe 2 might say yes, 1 might say no. 2 might give you one approval at a certain number, or maybe you get 3 different approvals. One says, 500, the other one says 520, the other one says 550. It's not because you're providing them with different information. It's because they have different overlays that say, hey, based on this person's credit profile and their income and their debt, this is what we're allowed to lend them out. Now, FHA does have loan limits and they change pretty much every year. FHA sets a maximum loan limit based on the county and based on the property type. In 2026, for a single family home, the FHA loan limit is $541,287. In high cost areas, that number goes up to $1.2 million. And for 2-unit, 3-unit, and 4-unit properties, that number is even higher. Now, one of the biggest myths around FHA is that it's only for first-time home buyers. That is not true. Just because it's popular with first-time home buyers doesn't make it a first-time home buyer program. You can own 2, 3, 4 houses and still use FHA. The key is that FHA has to be used as your primary residence. That means you have to intend to live in the property, even if it's a multifamily property. You can't use FHA to buy a traditional investment that you don't plan to occupy. If you wanted to buy, let's say you lived in Maryland and you want to buy a house in Florida for Airbnb, it's not something you could do with FHA. But if you want to buy a 2-unit, 3-unit, or 4-unit in a state that you live in, occupy one, rent out the other ones, that's absolutely something you can do, and it's something that we recommend. Now, I mentioned you can own multiple properties and still use FHA, but you can't have multiple FHA loans out in your name. If you currently have an FHA loan and you want to use that loan again to buy a different home, you're going to need to either sell your current home or refinance out into a conventional or a VA loan. So don't build your entire investment strategy on the fact that you're going to use FHA loan after FHA loan after FHA loan. You can do that. That's how we do the 4-3-2-1 method. But within that method, you're refinancing that property out into a conventional loan. It's the only way to do it. Now, one of the good things about FHA loans is that they do allow you to have a cosigner. But cosigners in real estate don't work how people think they work traditionally. In certain situations, you can have what's called a non-occupying co-borrower. That means the person is signing on the loan and their income, their debt, and their credit is going to be used to help qualify, but they're not intending to occupy the property themselves. Now, that cosigner, they're not just vouching for you, they're putting their name on the mortgage, which means that's going to show up on their credit, and if any payments are missed, it's going to affect them just as much as it affects you. Now, a common misconception is that a cosigner will somehow fix an issue of bad credit. If you have two borrowers on the loan, the lender is going to look at the qualifying score of the person with the weaker credit. So if you had two people, they're going to look at the middle of the lowest score between the two. So if your issue is credit and that's why you're looking for a co-borrower, that may not solve your problem. Where a cosigner can help is if the issue is around income or debt to income ratio. For example, let's say your credit is fine, but your debt to income ratio is too high based on your income alone. A qualifying non-occupying co-borrower could help strengthen the file. But again, this is something that you need to discuss with your lender early on because every situation is going to be different. Your debt to income ratio is one of the biggest factors when it comes to getting approved for a mortgage. It's basically a calculation of how much of your gross monthly income is already committed to debt payments. There are two ratios that lenders typically look at. The first is your housing ratio, which is your proposed mortgage payment compared to your gross monthly income. The second is your total debt ratio, which includes your new mortgage payment plus your other monthly debt obligations, like car payments, student loans, credit cards, personal loans, and other debts. FHA can be more flexible, meaning that instead of a, 30%, 40% ratio, they can go as high as I think 50%, if not higher, depending on the circumstances. Mortgage insurance is one of the biggest trade-offs for FHA loans. FHA requires both upfront mortgage insurance and monthly mortgage insurance. Now, when it comes to mortgage insurance, it's not something that protects you from default. It protects the lender from you defaulting on the loan. So there really is no benefit for the buyer when it comes to mortgage insurance, which is why we either want to lower that cost as much as possible or eliminate it altogether. But unfortunately, with FHA loans, it's not something that we can get around. The upfront mortgage insurance premium is generally about 1.75% of the mortgage loan. It can be financed into the loan or you can pay it upfront as part of your closing costs. The second piece is the annual mortgage insurance premium, also called MIP. This is broken up monthly and included as part of your mortgage payment. The annual MIP is typically around 0.55% of the loan amount. Now, with conventional loans, you may also have mortgage insurance, but once you get 20% equity or if you put 25% down, then that goes away. With FHA, it doesn't go away no matter how much equity you have in the property. You're going to need to refinance into a conventional loan in order to get rid of that monthly mortgage insurance payment. Now, that doesn't mean that FHA is bad. Sometimes FHA is the best option because it gets you into a home. What you should have is a long-term plan no matter what you want to do with the property. Some properties are for investments. Some properties are, the first property for a buyer and maybe they want to rent it out later. And some people are buying their forever home. So this is why we always focus on and craft a long-term strategy no matter what type of loan that we're using. Another big difference between FHA and conventional is that FHA properties have to meet minimum property standards. This is where it can get tricky once you're under contract, especially if your buyer agent or the listing agent isn't aware of what is required when it comes to FHA loans. When the appraiser goes out to the property, they're not just looking at the property to give you their determination of the value. They're also looking to see if the property meets the minimum standards for FHA when it comes to safety, security, and soundness. This can include things like peeling paint, exposed wiring, missing or loose handrails, roof issues, broken windows, utilities not working, or anything that they deem a health and safety concern. FHA is usually not worried about cosmetic items. Like they're not going to say you need a new kitchen just because the kitchen's ugly. But if the condition creates a safety, security, or soundness issue, it can become a problem. Because if the appraiser flags something, it now becomes a lender-required repair, and it has to be repaired before closing, and the appraiser has to go back out to the property to confirm that it's been taken care of. So if you're using an FHA loan, your agent should be aware so they can kind of go through the property when you are, when you're touring the property, your agent can kind of put on their, I call it my FHA goggles when I'm going through the property, and now I can kind of identify, okay, that might be something that comes up. That might be something that comes up. That doesn't mean that we don't move forward with an offer or that we're not interested in the property anymore, but we just know that when we go through our home inspection process, that we include those things on our repair list when we provide it to the seller. You can also, as a second, pair of eyes, if you do have an inspection done on the property, let your inspector know, hey, I'm using an FHA loan. If there's anything that you notice that could be flagged, for FHA, let me know. Because these are the things that, during your home inspection period, you want to make sure that you put in that request. So all that stuff can be taken care of and there's no issue when the appraiser goes out to the property. Because again, it's not something that's going to automatically ruin the deal unless the seller doesn't want to fix it, can't afford to fix it, or, whatever. But if they're aware of it early on to say, hey, look, I know we're going back and forth with negotiations on this list, but this thing isn't really, a non-starter because the inspector deems that's gonna be a lender required repair. Now, if you're buying a condo using FHA, the unit is not the only thing that's gonna be reviewed. The condo project, the building, the association, that also has to be approved. We call it an FHA approved condo. That means the lender or the underwriter is looking at the association, they're looking at the finances, the owner occupancy ratio, the insurance, the delinquency rate, the reserves. All these things play a factor in order for that unit or that building to be FHA approved. Common FHA condo issues we see is when there's too many investor-owned units. An investor-owned unit is just when you have a condo owner who doesn't live in their unit. They're not owner-occupied. They like that number to be at 50%. So if there's 50% or less non-owner occupied, then you're good to go. If most of the units are not owner occupied, then it may not be approved by the lender or FHA. The other thing is condo delinquency. That means condo owners are not paying their condo fees. The rule is no more than 15% of unit owners can be 60 days or more delinquent on their condo fees. If that's the case, it's not going to be FHA approved. You can't buy that condo. So if you're using FHA and looking at condos, don't wait until you're under contract before you send the building to the lender or inquire with the listing agent to see if the building is FHA approved, because you can open yourself up to delays and, some disappointment. HUD actually has an online lookup tool where you can look up to see if condos are FHA approved. But even if something looks promising, your lender still has to do their checks and balances to make sure that everything is good to go. And one of the biggest benefits and most underused parts of FHA is what's known as FHA 203K. That's the renovation arm of the FHA loan. 203K allows you to buy a home and finance certain repairs or improvements all in one mortgage. You have a limited 203K, which is for like smaller non-structural repairs. So if you wanted to paint or if you wanted a new kitchen, new bathroom, basically anything that you wanted to do up to $75,000. Then you have standard 203K, which is going to be for your larger projects. If you wanted to do an addition or if it needed structural repairs, or maybe just a full gut of the property. It's a great option where you don't have to pay for these repairs out of pocket. Now with 203K, it's a more involved process. You do have to hire what's called a 203K consultant, which is basically an overseer of the project. You have to have a licensed qualified contractor or GC who's going to be handling the project. You can't do it yourself. Can't hire, your friend off the street because he's going to give you a low price. Because again, if the lender wasn't involved with, the renovation, you can do whatever you want. But the fact that you're wrapping in the cost with the loan, now the lender wants to have an extra set of eyes on the process. So if you're thinking about using a 203K loan, make sure you talk to your lender about it and have them outline the specifics of what exactly is going to be needed, because you don't want to make any assumptions thinking that you can do this and you can't, or you can hire this person and you can't. Now, another great thing about FHA loans, whether you're using regular FHA or FHA 203K, is that the seller can contribute up to 6% of the sales price towards your closing costs. Traditionally, if we're looking at a conventional loan, that max is 3%. When you hear that there's a seller credit or a seller is paying towards a buyer's closing costs, typically it's only up to 3%. With FHA, you can go up to 6%. That doesn't mean the seller has to give you 6%. It doesn't mean the seller will give you 6%. It just means FHA will allow it. In the real world, whether a seller gives you seller credit or not, or how much they give, depends on the market, depends on how long the property's been sitting, depends on how motivated the seller is and how your offer is structured. If it's a multiple offer situation, I probably wouldn't expect to get anywhere close to 6%. Just be strategic and work with your agent. Sometimes it may be better to offer closer to list price and then ask for a full amount of seller help, whether that's 3% or 6%. Or maybe you offer over what they're asking for, because either, you can manage the mortgage payment and you really just need that out-of-pocket, you really need help with the out-of-pocket costs. That could be a different way. There's different ways to do it. So just work with your agent and your lender and, see what options are available for you. Now, if you're using an FHA to buy a renovated flipped property, you need to pay attention to the timeline. FHA will not insure properties that are resold within 90 days of the seller's acquisition date. For example, let's say a seller was, purchased a property that needed renovating, flipped it, did all the work that needed to be done in 30 days, and then put it back on the market. As an FHA buyer, you cannot go under contract for that property. FHA is not going to allow it. You have to wait until day 91. Now, if you're between day 91 and day 180, FHA may require a second appraisal. The good thing, though, is that second appraisal is not going to be charged to you. You'll pay for the first one, and then they'll order a second one, they being the bank. So if you're out looking at properties and you realize the property's renovated, you don't know if maybe the owner did it themselves or maybe it's an investor who went in, purchased it, and flipped it. But these are the questions that you want to ask because you don't want to find out after you're under contract that you can't move forward with the property, after you paid for the inspection and you wasted all this time thinking you're going to get this house. Now, let's bring it all together. What have we learned? FHA can be a great option and is a great option. They allow for a low down payment. They can be more flexible whether you have good or bad credit. It's not a first-time home buyer program. If you're a repeat buyer, you can use an FHA loan. They can be used for multifamily properties and house hacking, and they can even be used for renovation loans. But you have to look at the full picture. Your credit score, your debt to income ratio, your cash to close, your monthly payment, the mortgage insurance, the property condition. If you're using a condo, the condo association. Because the goal is not just to get approved. The goal is to buy the right property using the right financing structure that works within your long-term plan. So if you're thinking about buying a home in DC, Maryland, or anywhere in the DMV, and you're trying to figure out if FHA makes sense for you, reach out to me. My team and I would love to put together a plan for you. But do me a favor before you go. Like, subscribe, and share this video with someone who needs to see it. As always, my name is Daniel Walcott, your resource for all things real estate here in the DMV. I'll catch you guys next time.